Kenya's inflation figures have been on a steady decline for the first half of this year, from 7.8% in January to 5.8% in June. Despite a rise to 6.39% in July, the figures, largely attributable to stable macroeconomic environment, spell optimism into the second half of the year. Wendo tells us more.
Kenya's inflation in the first half of 2016 has been stable, playing well within the bounds of 2.5 and 7.5%. The stability is attributable to the steady performance of the shilling and reduction in oil prices internationally. In addition, the country's food basket has been bountiful owing to good weather patterns.
We've noted that the weather patterns have really improved. We have seen good rainfall over the long rains period. So I bet for most of the basket area zones, they have continued experiencing a good harvest. So basically, especially now that food prices account for like 36% of the inflation, of the core inflation, I think now coming from those highlights that we've seen the weather patterns improving, I think we have actually seen inflation coming down for the first half of the year.
Between the months of January and June, the consistent rise in prices of goods and services eased by 200 basis points to 2%. In the month of July, however, the numbers shot up to 6.4%, a rise attributed to a raft of tax measures introduced in the budget. The government, in an aim to improve the business environment, raised the road maintenance levy from 12 shillings to 18 shillings per litre of diesel and petrol.
The idea or the aim, the principal aim for the government here is to actually improve the tax collections. And this has various benefits if this manifests into what they plan to do. So if they do actually collect taxes at least close to the target or above the target, then hopefully they could reduce domestic borrowing from the local bond and bill market. And that should help stimulate private sector credit growth, because that's not going to crowd out the private sector.
The hardest hit subsector was the alcoholic beverages, tobacco and narcotics, where the consumer price index rose by 14.2% year-on-year. Key among the reasons for this is the increment of excise duty per litre of beer brewed in the country to 43%, imposed in December 2015.
We have seen a huge rise, especially between last year July and this year July. That's where we have seen the biggest rise. This is mainly because we saw change in the taxation policy in the month of December 2015, where some of these alcoholic and tobacco products, they had an increment on the excise duties. So for instance, beer, the excise duty was coming from around 70 shillings per litre to 100 shillings. For spirits, it was coming from around 120 shillings to 150 shillings for the excise duty.
The tax increase actually had the opposite effect of the desired impact, which was to increase revenues. What actually happened was volumes dropped so much that we disappointed, it was disappointing for our own business, it was disappointing for Kenyan consumers, and actually it was probably disappointing for government as well, because increasing revenues through tax actually had the opposite impact. So the conversation we want to have with government is, how do you find that sweet spot of having the right and appropriate level of taxation for our brands and our categories, but not overheating it so much that people walk away from the category.
As political temperatures rise ahead of the 2017 general election, there are fears of a spike in inflation due to high liquidity in the market.
Inflation generally, in an election year, normally rises if there's printing of money. So that's always a concern. So the other risk for inflation in the election year is obviously if there's fiscal stimulus, or there's robust fiscal spending, and this is supplemented with a potential rise in oil prices, or at least relatively higher than where they are today.
On the supply side, it actually strains on the political side, and then on the customer side, consumption increases. So at times you have lots of stockouts and things, and so we are preparing for that scenario, because suppliers, some of them kinda tend to secure their or ring-fence their investments, so they actually lower their risk by having less items and less stock holding. And that's now buoyed now by a population that now has money in circulation, and lots of money in circulation now creates a whole big push and pull.
Other looming concerns include drought within the East Africa region. The pandemic, which follows a 5-year cycle, was last experienced in 2011 and is expected again later this year.
We have a more strained time drought period and all that, we're definitely going to have some negative effect as far as meat and meat products are concerned, either chicken or beef and all that. But otherwise, when it comes to the greens and all that, we are well prepared for that. Cold rooms already in place. Milk, luckily, we've had most of the key suppliers currently. They have clear talk that they have now powder capacity. They have increased on the greater powder capacity and long life. So long life milk is actually doing well, especially in the regions of traditionally affected markets.
All factors remaining constant, analysts predict a positive trend in inflation, falling within the central bank's target rate.
This month we're probably going to see some, I'd say mild food price pressures because the government has increased the price of maize to 3,000 shillings from 2,600 previously for 90 kg bag. But what we notice is that food prices, at least the rise we've seen over the last 2 months, is probably going to prove to be transitory and not persistent. So that's one of the risks we'll flag. But we generally believe that we'll peak at levels around 6.7 in December and thereafter fall back to below 6% and possibly end the year at 5.5%.